right? So number two, so the idea of sort of being in the club, it's okay to want to be in the club. Some clubs are valuable, some clubs are worthwhile. Some clubs are just hype and they're just sort of using the exclusivity to get you to want to come in because human beings naturally want to be a part of things that they can't be a part of, right? They want access to the things they can't have. Number two, he had very consistent returns, almost to the point of being boring. So people felt safe because there was that consistency there 8%, 8%, 8%, 8%. So he created the illusion of stability to make them think that their money was going to come in like clockwork. And that's another trick too. The thing about risk, remember, I spent a lot of my doctoral program studying risk. And the thing about Madoff gave the impression that there was no risk, right? Sometimes a lack of risk can be an illusion. And it creates what is referred to in finance. We call this the peso problem. The peso problem is when the Mexican peso created the illusion of low risk. There was the illusion that if I bought pesos and sold dollars, that I could just make money like clockwork. And a lot of times, not being conscious and not really sort of investigating before you invest, right? Before you invest, you should investigate. Not going through that due diligence process can create the illusion of stability where there is none. So that's what Bernie Madoff did. What's interesting is there were people at the time for many years who saw that Madoff was full of it. There was a guy who did stock options who said it's impossible for a man to have returns this consistent. It's impossible for him to make this money consistently during the down markets and everything else. That's not probabilistically, a reality, right? That's not real. And he went to the SEC. They didn't believe him. He told other investors they didn't listen. He had tried to get him investigated multiple times. He wrote long letters. They never replied, and he was able to rip people off. The only time Madoff got discovered was in the '08 market crash. When the market crashed and people had to pull back the curtain and see if the Wizard of Oz was real, that's when they started to realize, oh my gosh, this has been a scam the whole time. There was something called reputation armor. So because Madoff used to be the chairman of the Nasdaq, he had kind of this prestige factor where people will say, how dare you question the chairman of the NASDAQ? A lot of times when people don't want you to know something, they won't give you the answer that you're looking for. Anybody ever seen that where somebody's lying to you and rather than just proving that what you're saying isn't true, they gaslight you by saying, "How dare you ask the question?" Anybody ever seen that? You probably seen that maybe in a relationship or something, right? Or whatever, right? So let me know if you guys can still hear me. I want to make sure you guys can hear me. Is my audio coming through okay? Because the chat's really quiet. I'm not seeing a lot. Okay, I'm making sure. Just making sure. All right, you ain't got to chat. I mean, you're sitting there. That's telling me, okay, I need to just make sure we ain't dead up in here. All right. So reputation armor was big for Bernie Madoff. There's also sort of he also sort of used this sort of secrecy to kind of say that he has this secret method. He called it the split strike conversion strategy. So, which was bullshit, right? But basically, he used that term to say, "Hey, look, this is complicated. I'm generating these returns." And it's a proprietary method. We're just too smart for you to get it, and that's why you don't understand what we're doing. And then there's something that they call affinity bias, which is he used it on Jewish people. He's like, "Hey, I'm Jewish, you're Jewish. We Jews got to stick together." And we see it all the time in the black community. If you look up the case of Ephraim Taylor is an example of somebody who did that to the black community. He would go to Bishop Eddie Long's church and other churches, and he'd say, "Hey, I'm black, you're black. I'm a Christian, you're a Christian. The Bible says that we should be plentiful." And, like I can throw around Bible verses in a certain way that will make you say, okay, he's just like me. A lot of people gave their life savings to Ephraim Taylor and they lost everything, right? Ephraim Taylor is in prison right now. And he was really big around like '09, '10, and or '08, '09, something like that. And so you might compare him to what like kind of where Earn Your Leisure is right now, that kind of thing. Like he was kind of out there, like I'd heard about him. And unfortunately, he got caught in kind of a Madoff sort of scenario where this affinity bias kicked in and led to people giving him a lot of their money. So a few theories you should know about in terms of methods of persuasion that people use. You see it all the time. You see it online, like a Grant Cardone will use this stuff like that. One is social proof. And a lot of people falsely believe that if everybody else believes it, then it must be true. Social proof gets you into a lot of trouble because social proof is basically following the crowd, and they're tapping into a natural human instinct that says that when if everybody's doing it, then it must be the right thing to do. And I'm gonna tell you, that's just an insane way to live your life, in my opinion. I don't understand that, and I reject it. I curse it to the root. I do not, on any level, attribute or subscribe to any of that. My goal is literally every day, I look at what the crowd is doing and I ask myself, does this make sense? And if it doesn't make sense, then I become that guy who will say, this is stupid. This is dumb. Like, why are we doing this? This makes no sense, right? So, um, so what I would say is don't let this happen to you. When it comes to making your financial moves, the biggest thing you should know about investing is that the people that make the money tend to be the contrarians. It's the people who buy when others are selling and they sell when others are buying. And with this market, that's really important to understand because in this market, you have a lot of activity right now. You have a lot of stuff going on that where you got stocks that are doubling in a week, and so everybody's buying into this stuff. And it's okay to participate. I told you all, I don't think selling everything right now in this market is a good idea. At the same time, you got to watch your back because Morgan Stanley just released some warnings that a market correction is probably on the way. A couple more things that happened with the Bernie Madoff situation that caused people to lose so much money is there's something called cognitive dissonance, where you just don't want to believe it's true. A lot of us go through that. You just don't want to believe it, right? So people, when they were confronted with the truth, many of these people were warned before they lost everything. They just didn't want to believe that this guy would do that to them, and we all fall for that. Here's the thing: you can never outsmart your emotions. Remember that as an investor. You can never outsmart your emotions. I don't care how many master's degrees, law degrees, PhDs you got. You see people out here with all kinds of education doing really stupid things when it comes to love. That's very emotional. It's very physical. It feels good, right? How many times have you seen that where somebody falls in love and their IQ drops by 100 points? Um, when it comes to things like drugs and alcohol or addictions, and when it comes to persuasion, you cannot outsmart your emotions. The only thing you can do is learn to understand them and become as emotionally mature and intelligent as you could possibly be to the point where you can say, gosh, I'm really feeling this way. I know that I'm feeling this way and I know that this is probably not good for me. So let me go ahead and try to process in a way where it's not going to be harmful for me. So Bernie Madoff was able to emotionally manipulate people through things like the cognitive dissonance and authority bias, social proof, and authority bias. That's another one as well. Authority bias is where people just believe that because he was the authority, that we should do what he tells us to do. And you saw this happen during the pandemic. You'd have people pop up and say, I'm Dr. So and so, and they put me on TV. So everybody should go get this shot, or whatever, right? Or Bill Gates 20 years ago was saying, was going around with all these experts saying that the world's population is getting too big, so we got to stop having babies. Like stop having so many kids, have one, and that's it. And now 20 years later, they're like, oh, sorry, we were wrong. We made a mistake. And so what that speaks to is when it comes to authority bias, one thing that I will say as a quote unquote authority in certain ways myself, right? Like a PhD does mean something. What my PhD does for me also is it lets me know that all authority ain't good authority. And also it tells me that all authority, if you're asking me to really change my opinion fundamentally on something that's very important to me, I need to get a second opinion on that. How about that? I need to get a panel of experts. I need to hear from you and you and you and you and you and you and you, because if I'm going to change something that's really just contrary to what my research tells me to do, I need to make sure that we're clear on this. And so when it comes to Bernie Madoff's victims, I would almost say that I don't understand why you decided to, like Albert Einstein's daughter. I would ask her, I'd say, what made you think that it makes sense for you to trust all of your family wealth to one man anyway? And I get it though. I understand she's not a financial expert, right? So maybe that makes sense to people. But I'm gonna tell you that don't make no sense. Don't put all your wealth in the hands of one person. I don't care if it's your spouse. I think it's Phyllis Hyman. Phyllis Hyman, the singer, is that her name? She sings that song, Look at Me. Is that Phyllis Hyman? Somebody help me because I don't know. Because I became intrigued with this lady because she sang, she has such a beautiful voice. And I was up at 3 in the morning scrolling through YouTube and I saw this 1962 video where this lady starts singing and she just goes, Look at me. And everybody starts clapping. I'm like, oh, this must be a big song. And I became intrigued with this lady. And it was maybe it was 1952 or something. And I was intrigued with this lady to the point where I was like, I want to know her story. So I Googled her. Is it Nancy Wilson then? Is that I don't know. I get the names wrong. But here's the thing. When I looked at her story, because I'm always intrigued by the rise and fall of stars. Like where did you get discovered and what was your life like as a child and what was your big break and what were you like at your peak and then what was the drama that happened along the way, your relationships and everything else, the addiction or whatever, what went wrong, right? And so with her, I what the big mistake that I saw with her was she kept getting famous and rich, and she kept giving her money to her husbands because at that time women were trained to just trust your husband, trust your husband, trust your husband. And I think that you should trust your husband, but I do think that there's something to be said about your husband being trustworthy. But even beyond that, I still think that it's okay to still have, like to sort of be thoughtful about whether or not you should put everything in the possession and control of one person. I know it's kind of sacrilegious to talk about that when it comes to a spouse, and there's a lot of things I trust my wife with, but diversification is one of the most important rules of investing that there is. And I think that to some extent that even comes up when it comes to people. So maybe if I trust my wife with the money, I got to know what's happening with the money, right? And then maybe I also have other pockets of money just in case the pocket that she's in control of somehow gets lost. I counseled a couple in Brooklyn one time, or the Bronx, and they were going to get a divorce because the wife had trusted the husband with the money, and the husband had a dream of wanting to start a record label. And so he took all the money and put it into this business venture to start another record label or something. And it didn't work. And so suddenly all the money's gone and she didn't know why the money was gone. Right. And so I'm not saying she was stupid, I get it, right? Because society tells you, social proof, right? Everybody does it. Everybody trusts their husband with everything. I kind of wonder if there's a better way to kind of view it, to kind of say, yeah, I trust you, and I'm going to let you control a lot of assets, but I'm also going to make sure I know what's going on. And then on top of that, I'm going to have the money in different places. So while my wife has access to a lot of our resources, I also have money in this account, this account, this account, this account, this account. I have assets over here and here and here and here and here, right? And so this idea, this old school notion of I trust Bernie Madoff, I'm going to give him all my wealth. I think that's an unnecessary risk to take. That's my point. All these so-called sophisticated people with literally billions of dollars in the bank were naive enough to put all that in the hands of one guy. And there is no one guy that I would do that with. I would not do that if his name was Jesus. I love Jesus. Don't get mad at me. I sound like a heathen by saying that, but seriously, like literally, no. So that was something I wanted to share with you. If you want to go watch the video again, it's on my Instagram. My Instagram is Dr. Boyce Finance, so feel free to go take a look at that. Also, just so you know, I made a list of stocks you guys can go take a look at. If you go to drboycestockmarket.com, in what Dr. Boyce is buying, I put a lot of stocks that I like there as well. So feel free to log in at drboycestockmarket.com. All right, so what I'm going to do is answer your questions, and you guys can tell me what's on your mind, and also we can talk about what's happening in the market. So. All right, let's see here. So first question is, do I think Chipotle is a good buy? I think Chipotle is a great company. I think that they're having some trouble. The stock has not performed this year. It's actually been an underperformer. Um, Here's what I believe with Chipotle, and I can prove I believe it because I put my money where my mouth is. I believe long term Chipotle is a good investment. The ticker symbol CMG. I'm opening up my portfolio now because sometimes I've talked to you guys about stocks. I like to buy them while we're talking. I bought more Chipotle. It's hard though. It's like one of these things where you got to hold your nose and do it because Chipotle's performance has been so terrible. I'm trying to look it up now. It's just been so bad, and I'm not used to that. Chipotle is usually a pretty solid investment in most years, but not recently. So yeah, so that's how I feel about Chipotle. So if you believe they have a good business, which I believe that they do, then you can look at this as a great opportunity to get involved with a stock that's temporarily having a bit of a struggle. So, but I think Chipotle is just a great business. What's the difference between Google and Goog? Googl and Goog. One of the shares are voting, the other ones are not. I think the one with the L means you have voting rights. And if you want to know my opinion about Google, Lord Jesus, I love Google. If I was a single man and Google was a lady on the street, I'd want to walk up and take her on a date because Google is that company that I just think is such an awesome investment. They're well diversified. They're on the cutting edge of AI. They've got a lot of undervalued assets that don't get recognized by the market as much as they should. So, and then also, I believe that they got something up their sleeve. I think they're going to make a big partnership with Apple because Apple's suffering on the AI front. And I'm looking at Google right now to see if it's up or down today. I think it might be down a little bit. Today might be a good day to go shopping. Let me see. Google is down 1.85%. Ah, look at that. And I think I own Class A shares, the one with the L. I think that the one with the L is where you have the voting rights. Let me see here. Um, okay. Yeah, let me see. Yeah, the one with the L has voting rights. So the Class C shares, the one with the G does not have voting rights. I own the ones with an L, and actually, I'm going to buy me some more Google right now since it's on sale. Why not? Let's go shop. Let's see here. How much money we got available? What's the price? 277 per share. Let me pick up some more shares real quick. All right, so there we go. And if you want to know which brokerage I use for that, it's Schwab. And Schwab is a good broker, in my opinion. Karen, good afternoon, Dr. Boyce. I want to thank you for all you do for us. Oh, thank you. Thank you for participating. If it wasn't for you, Karen, I wouldn't have anybody to talk to. I wanted to ask you, what do you think about SLB and PBR? SLB and PBR. Okay, I don't know either one of those companies. Um, so let's see what we can say we said we saw. Um, be really careful about, sort of getting excited about a stock after it's gone up a whole lot, because that's when it takes the headlines. I like the stocks when they're kind of struggling a little bit. Okay, so SLB, okay, it's up a little bit this month, but not too much. Let's see, PBR is down. Okay, good. Maybe this is a good time to buy. Let's see. Let's see what's going on. Okay, so SLB, they're a global oil services tech company. They operate in 100 countries, so you get nice global diversification here. Okay, check. It's shifting into more digital tech offerings. The digital integration business is getting traction, AI automation to help oil and gas clients to do more with less. Okay, they're returning capital to shareholders with buybacks and dividend increases. Okay, that's an important point. When a company is buying back its own stock, that tends to boost the price a little bit because it's showing insider confidence in the company's prospects. It's the company saying, "Hey, we like our stock. If you don't want it, we'll buy it." Right? And that's when everybody should be buying back their own stock. Meaning, like if you have a job and then suddenly they let you go, rather than looking at it like, oh my God, I'm worthless now because nobody wants me, I would look at it as, wow, I've got a whole 40 hours a week of free time that I can pour into me and pour into things that I can do for myself. And I want that actually, like I couldn't, I got to the point after I left Syracuse where you couldn't hire me for a job because if I came to work for you, I couldn't be working on all the really important stuff that I was doing on my own, right? And that was me buying back my own stock or buying back my own time. Like I wanted to get off the plantation so that I could buy back and invest in me and invest in this and invest in my business, invest in my family, invest in the things that matter for me, right? So ultimately, the fact that they're buying back their own stock is a vote of confidence in the potential of their own company. Also, the increase in the dividend, that's another thing to pay attention to. Companies increase their dividends when they're confident about future cash flows. My wife's calling me. Give me 1 second. Hey, babe, I'm in class. You need something? Yeah, thanks for letting me take that call. My wife's not feeling well. She has a sinus headache, so I got the trusty Claritin B, and I'm gonna have one waiting for her. I am her drug dealer. I'm your mama. I'm your daddy. I'm the scholar in the alley. All right. So why am I blurry? Okay, I'm blurry right now. What's going on with this? Let me turn this off and on. There we go. All right. Okay. So let's keep going. Yeah, Claritin D. That's the only thing that works on my allergies. And when we're in Atlanta, the if you have allergies in Atlanta, it's just a nightmare. All right, and same thing in Louisville, Kentucky, where I was born. Okay, so Petrobras is a large oil and gas company in Brazil. Okay, so the risks are that oil service businesses are very cyclical, so demand depends heavily on upstream spenders, oil gas producers. PBR, so Petrobras has what they call political and regulatory risk. So if the Brazilian government changes policy, that can affect the company. Um, so it looks like both of these companies are kind of in similar industries. Uh, I don't know if I necessarily see a reason to invest in either company over, say, an ETF that just gives you oil and gas exposure. But, you know, let me see. So I would start, if you're interested in oil and gas, I would start with an ETF and I'll find one for you. But I'm looking here and SLB, I like the fact that they've increased their dividend. That speaks to the idea that this company might be um, an organization that has a lot of belief in its future potential. PBR concerns me because of the regulatory risk, just this idea that the government can step in and take all your money. If you're looking for an oil and gas ETF, XLE is the Energy Select Sector Spider Fund, and that gives you oil and gas exposure. It hasn't done that great this year. Well, actually, no, wait, sorry, it has. My apologies, a little bit. It's so up and down though. It's up 8.3% the last 6 months, which is good. But year to date, it's only up 0.62%. So in the last year, it's negative 3%. The last 5 years, 130%. So this is not one that's gonna like be a barn burner for you. Um, but let me see here. I'm looking to see. But if you're looking for exposure to oil and gas and that industry, and sorry, forgive me for not talking fluidly. I'm reading here. Um, yeah, so you're gonna get less upside, but you're gonna have less volatility. So if you're looking for high risk, high reward sort of scenarios, then the individual companies can provide that. Like that one that we mentioned before was SLB. But if you're looking for something that's a little more stable, then the ETF would give you that. All right, so let's see here. Janet, what are your thoughts on NVTS? Yeah, NVTS. I like it for options. I don't necessarily feel like it's a great long-term investment, but I think I do own that stock actually. Let me see here. NVTS. Do I own that or am I? No, it's NBIS that I own. Okay, NVTS. I do not own NVTS. Okay, so Navitas Semiconductor. Well, I mean, it's connected to AI and data centers. That's a big deal, right? This is a fast-growing industry. There's a good chance of overcapacity though. The data center build out is so rapid and they're starting to borrow money to build these data centers, which is a risk factor there. And if the AI demand isn't what is people expect it to be, or if the hyperscalers start to slow down their spending, that could not just impact the stock market. That could actually just wreck the entire economy. And so, but ultimately, the fact that their earnings growth is somewhat weak is a problem. In fact, they had a revenue decline in their last Q3 guidance. That's not good. Also, they have what's called execution risk. The fact that AI data centers are capital intensive and they take a lot of time means that if it doesn't work out, then that's a problem. So this would be more of a long-term AI infrastructure play. I'm not a fan of this stock if you are worried about sort of being in a risky speculative position. Now, if you have patience and you have a lot of faith in this particular company's ability to execute, then it might be worth looking at. But I think that there are other companies in this industry that might be better alternatives, safer alternatives. I'm trying to look here to see what other stocks are. Huh. Um, Really, this stock is in sort of this class of like these really high risk companies. So if I were to involve myself with NVTS, I'd probably use it to sell stock options or something. Let me see the price of the stock. What's today? The fourth, the fifth. I can sell calls. I mean, my goodness, wow, interesting. Okay, so the share price is 10.96, and you can sell a $12 strike price call for 90 cents a share. So theoretically, if a person owns, say, 1,000 shares of this stock, you could make 900 to $1,000 in a month just selling the options. And so that immediate payback of selling that option can reduce the cost of the stock for you and also reduce your risk. So I wouldn't just buy it just to hold it because there's something about the stock that makes me worry that if the market goes south, that stock's going to crash and burn. So that's one of those crash out companies, in my opinion. Um, can you open VOO and RH in Robinhood and explain the area between volume and expense ratio? I'm trying to make sense of it overall. Okay, so Karen, I can't open it up on Robinhood, but in terms of, I can tell you what volume is and what expense ratio is. The expense ratio is just basically the expenses that are charged, by the people that manage that fund. And so, if the Vanguard S&P 500 ETF, give me a second here. I'm looking this up. And VOO is a great long-term investment. If you're talking about something where you can just set it and forget it and make sure the kids are wealthy, if a person just bought VOO every month for their kids will be rich, and your kids will never have financial problems in their whole entire life. Because what VOO does is it just tracks the S&P 500. You have 35% invested in technology, so you get exposure to that. You have 13% in financial services, 2.3% in energy, 10% in consumer cyclical. The top 10 holdings, again, can't go wrong with this. NVIDIA, Microsoft, Apple, Amazon, Meta, Broadcom, Alphabet, Tesla, Alphabet, C, and Berkshire Hathaway. So you're connected to the U.S. economy. If the economy keeps growing, then your wealth will grow. And even if the economy didn't keep growing, by you putting that money in there every month, your wealth is gonna grow because you got more money put to the side, right? One of the things to never forget is that stocks are a natural savings vehicle. The first and foremost benefit of owning stock is a stock is a store of value. So, if you imagine if you lived in a world where you couldn't see the stock price and you couldn't see the prices go up and down, up and down, up and down, up and down to create all this artificial anxiety over this asset that, in some cases you may be planning to own for the next 10 or 20 years. If I pour a bunch of money into a stock, I've got this asset that's worth a lot of money. So instead of thinking about it like stock, imagine if it's real estate. Imagine if you could buy real estate for $1,000. Instead of buying a whole acre, you could buy like, I don't know, 10 square feet of real estate. And you just bought, and so you just said, okay, every month I'm going to buy 10 square feet of real estate. And over a year, I'll get 1 acre. Next year, I'll have 2 acres. Next year, I'll have 3 acres, right? And imagine if you just did that consistently and you accumulated all this land. Well, if you do that for 20 years straight, you're going to be rich. Wow, well, because you've engaged in the long-term accumulation process of an asset that you hope is appreciating in value. But imagine that nobody ever told you what the value of the land was. Nobody ever said, your land, you purchased it for this much and now it's worth that much, right? You just owned a bunch of land. Well, then you would definitely be in a better financial position than you would have been if you hadn't purchased the land. So acquiring stock, I think, can be thought of in the same way. There's a lot of anxiety that people have about their stock prices going up and down, up and down, up and down. And they feel like if the price goes down, that they've lost. That, oh man, that was bad. I invested and I own this stock 5 years and it's worth less than what it was when I bought it for. You didn't lose. You did not lose because you own stuff. That's the key to wealth and power is owning things. You don't go up to a rich man and measure his wealth by whether or not his assets went up or down in value this year. You don't do that. You just say, oh, he owns three apartment buildings and 50 acres of land. He must be rich, right? So the same thing is true with stock accumulation, right? So let's circle back with VOO. The expense ratio on VOO is non-existent, basically 0.03% per year. That means nothing. They are charging you a fee to own the ETF, but it is so small that it doesn't matter. In the 90s, that wasn't the case. In the 90s, those fees were really important. They wrote entire research papers about expenses and fees. Robinhood wiped all that out for the most part, as well as digital trading and everything else. Now, in terms of volume, so trading volume would be the dollar value of the amount of trading that happens with that asset. It's very hard to make sense out of a trading volume number. If I told you the volume of a stock, there's not much you can do with that information. I wrote research papers on volume and it means things, but it doesn't mean anything for an average investor. Um, what volume indicates, though, for the most part, one way to sort of think about volume is that stocks that are very popular and well known, like Apple, they tend to have a lot of trading volume, which creates a lot of liquidity. So think of it like a nightclub where there's 1,000 people in the club, right? There's 500 men and 500 women. Well, there's going to be lots of transactions happening in that building, if you know what I mean, right? There's lots of opportunities. If you're there to look for a man, you're going to find a man because there's 500 men to choose from. If you're there to look for a woman, you're going to find a woman because, again, you have all these choices. So ultimately, volume really is a powerful force in a market because it gives you options and choices in terms of the ability to trade your asset without there being a high, what they call transaction cost. It's not hard for you to offload what you own because somebody's always willing to buy it, right? So again, you think about it as a big nightclub. Let's say there's 10,000 people there, like thousands of people. Don't matter what you bring in, what you bring to the table. Somebody's gonna want what you got, right? You weigh 300 pounds, somebody likes the big girl, right? Or maybe you are a short guy, there's some girl that loves short guys, right? You never know, right? So I would say that's important to remember because some assets that you buy have no volume at all. They have no liquidity, they have no traders. So you can buy, and it happens a lot with stock options. Be really careful with your options because let's say that you do some sort of you purchase a put spread that expires a year and a half from now, and then you say, okay, the stock moved in my direction. I want to close this trade. You'll go in there and you'll find the bid ask spreads will be massive to the point where the spread eats away at all your profit, right? And that's because you don't have enough volume. You don't have enough people out there that want to buy that thing. So if you don't have any buyers, then you can't be a seller if ain't nobody buying. You're getting on, it's like going to the playground, you're getting on the seesaw, and there's nobody else on the other side of the seesaw. So you can't play today, right? So keep that in mind. Volume and volume is important. Volume links to volatility. Sometimes if there's a lot of volume, extra volume, there's a lot of, and also information matters as well. So when there's tons of volume, lots of trading, there's typically lots of information being exchanged and lots of what they call information dispersion, meaning that there are different people there trading for different reasons. The bulls and the bears all have a different reason to come to the market. The bears are coming to the market because either they believe things are going to go south or they want to be prepared for that. The bulls are showing up because they believe things are going to go up or they're hoping for that, right? So bulls and bears make the world go round. Everybody can't be a bull. Everybody can't be a bear. If everyone becomes a bull on a given stock, then the market's out of equilibrium. It's like going to the club and everybody's a dude. Some clubs are like that. I know, no disrespect, but still, in most contexts, if everybody's a man, then that's an imbalance a little bit, right? So if everybody's a bull, then what happens is that the price starts to shoot up because all the bulls are there to buy, and nobody's selling though. Everybody's like, I'll pay $1, I'll pay $2, I'll pay $3, I'll pay $4. So what happens to the stock price if everybody's a bull? If everyone wants to buy, then what happens to the price? What's the price going to do? I'll pay $5. I'll pay $6. What's it going to do? I'll pay seven. No, no, no. I'll pay eight. What happens? It goes up and it's up and it's up and it's up, right? So what happens though is it keeps going up, 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 up until you hit a new equilibrium where there's a point. There's, they may call this the marginal price, where there is a point where some of the bulls say, "Whoa, whoa, I don't want to buy it. I would have bought a nine, but I'm not buying a 10. That's a little too rich for my blood." And so what happens is that the bulls change form. They change gender, if you will, right? The buyers become sellers. You have people that say, I don't want to buy at that price, but I'll sell at that price, right? Right. So ultimately, the equilibrium comes where in the end you have an equal number of bulls and bears because the price moves up and down to keep that balance. So it's really a beautiful process. If you let markets work, it's really a magical thing. All right. So with that said, Ricardo, Joby and ACHR, the eVTOL companies, which is better for the long term? Analysts believe ACHR will be worth more by 2030. You know, I own them both. I own them both because I like the eVTOL market, but remember that's a market that's gonna have some ups and downs. Most of the time, when you try to participate in an industry in its infancy, think of it like you're gonna watch a movie where there's a lot of different things that are going to happen in this movie. Or what, watching a football game. Like I saw this game, this amazing game with the Bears against I forgot who they played. The Bengals and the Bears. And it was a wild game. One minute I knew the Bears were going to win. The next minute I knew the Bengals were going to win. Then I thought the Bears were going to win. Then I thought the Bengals were going to win. So when you enter into this new industry, like you say, okay, I want to invest in eVTOLs, and so I'm going to buy shares of Joby or ACHR. Um, just be ready for the fact that between now and the time when this industry is fully functional, maybe in a decade from now, you're going to have times where the stock prices are flying high and you're going to have times where they're going to crash. So when you pick that thesis, you kind of have to have a commitment. You're marrying that idea through richer for poorer, sickness and health till death do us part. So with Joby, and the reason I'm an advocate of owning both is because you don't know which one's going to win, right? Maybe it becomes a winner take all market. Maybe Joby takes over 90% of the market and ACHR falls to the wayside. So basically, in my view, with the bull case, if we want to look at the bull case and the bear case of Joby, Joby is big in the eVTOL market. That market seems to be growing. They've really secured some really amazing partnerships with like Toyota and stuff like that. I think they're doing stuff in the UAE. And so they've hit a lot of key milestones. I'm looking at notes here. Flight testing, aircraft deliveries to the Department of Defense, agreements on commercial operations overseas. And so a lot of people believe that there's a lot of upside on the stock, and some forecasts predict that the stock could reach the $30 to $40 range by 2030, which I don't know what's it trading for now. Let me see, because I own Joby. I just haven't looked at it today. Um, Joby. Joby is $15 and it's down. It's down. This month it's down 20%. So if you believe in Joby, this is your chance. You can buy this, $15 stock. It's great for selling options. My position, I kind of calibrated some of the risk. I sold some options on the upside. My strike prices are $27 and $22. Right now, those strike prices are pretty far out. And so that means I still own a lot of the upside, but I want to be prepared in case the stock decides to decline. Let's see, the bear case is that the company's still pre-revenue and unprofitable. So that's a risk. Also, the valuation has priced in a lot of their milestones. So some of the price targets are actually lower than the current stock price. So you could see additional decline in the stock as well. And so just keep that in mind. Tariffs also are starting to come up in the conversation. The Trump tariffs were seen as this thing that should have an impact on the economy, but just wasn't for whatever reason. Now people are starting to see areas, rips and tears in the economy as a result of the Trump tariffs. And if Congress is successful at repealing the tariffs, or if the Supreme Court rules against Trump on the tariffs, all hell's gonna break loose. It's gonna be ugly. It's just gonna be a mess because the world spent a year getting used to, the idea of the president wanting all these tariffs, which I didn't agree with. All these, I think the tariffs went too far. And so for them to sort of say, "Oh no, 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 that's not legal. We're going to go in the other direction," that's just going to create chaos and uncertainty. Uncertainty is very bad for an economic system. Now, Archer, it looks like they've carved a position in the market. They have partnerships with the United Airlines, Korean Air. Analysts are pretty optimistic on this stock as well. Some have calculated an intrinsic value of almost $30 a share. So let me see, ACHR. Let me look it up. Archer Aviation. Oh, it's now $9 a share, and it's down today. It's down 18% this month. So it looks like these stocks kind of move together. They're like twin engines. For the record, analysts seem to like ACHR a little bit more than Joby. Joby, and it's not because they don't like Joby as a company. I think that it's because they maybe believe Joby is a little more overpriced. Joby. Joby is the ticker symbol. Sorry. Thank you. Thank you, Natasha. Yeah, so I don't know. I almost feel like having a little portfolio. Like if you have an industry that you're interested in and excited about, form a little portfolio of stocks in that industry that you can own that will give you broad exposure to that industry, right? If I was to form a portfolio of eVTOL stocks, I don't know, what would that look like? I don't know. Let me see. Let's see what we can find here. So Joby, ACHR, Archer Aviation. Let's see here. What are some companies that you might add in here? Let's see. There's one called Eve Holdings, and their ticker symbol is EVEX, EVEX, V as in Victor. There's Ehong, which is a Chinese eVTOL maker. That ticker symbol is EH. Um, I don't know. I mean, that's not invested in Vice, of course, but these are companies that are out there. So yeah, why not? I mean, if that's and that's the way you approach an industry. You don't approach an industry by picking a company. That's you're taking on too much risk. You're taking on idiosyncratic risk because you're betting not just on the industry, but you're betting on the company. So you're placing a double bet. You're doubling down on your risk exposure. And I just don't think that's necessary. But sometimes you have a favorite. Sometimes you have a company where you're like, I really like this company. Maybe it's because of the CEO or your belief about the company. And that's okay too. Because what that does is that gives you that chance to have that crazy upside, potential. Remember, diversification is more of a low risk approach to things where you're limiting your downside but you're also limiting your upside. Don't forget that. So if you ever get a feel that you want to swing for the fences and just balls to the wall, like I'm willing to lose everything or whatever, then individual stocks or even elite option might be the best way to go, like some sort of long-term call option, right? So let's say, for example, you go back to ACHR and Archer, and it's priced at 993. And let's say that I really want my wealth to swing forward on this stock in the event that it does take off. Then you can maybe look at, let's see, I don't know, but let's say you go to January 15, 2027, and you buy a call, and the current price is 993, right? So say you pick a strike of $10, you could buy that call for $3.90. So I could take, I don't know, let's say I bought 10 of these contracts for $3,900. That gives me the rights to buy 1,000 shares at $10 a share, and I'm paying $3.90 for that. So I'm going to pay $3,900 for this investment. I got a year. I have a ticking clock. If this thing doesn't move in a year, then I'm out of luck. I can lose the whole 3,900. So you got to be ready for that. If the stock goes down or doesn't move up, then that's a problem for you. And the other challenge is that in order for you to actually get to the point where you can say this is a profitable move, the stock doesn't have to just move to 10, the strike price. It has to move to $13.90. So you're really taking a bigger upside bet. But in the meantime, if good news comes out next month and the stock decides to move up another 20%, then the price of that option will go up as well. So you got short-term and long-term opportunities to make money, but you also have that possibility that you might lose everything. So if you are okay with that risk and that feels comfortable to you, then the options are available. And look at the prices. If you pick a $12 strike, there it's $3.40, and that's the January 15th, 2027 call option. And the other benefit is that it allows you some degree of ability to get involved with the stock without having to put up a full $9.92 a share. So it's up to you. But the downside though is you don't get margin. You have to put up all the money. Whereas if I buy the stock for 9.92, maybe I have to put up $5 or $6 a share if I have margin on Robinhood. All right. So everything has a yin and a yang. Everything has a pro and a con. Most financial decisions are not yes or no all the time. That's just not it. It's more like, what do you want to do? Wait, how do you feel? Angela, what do you think of the ticker symbol ET, Energy Transfer? Um, Energy Transfer, and this is, let's make this the last stock we look up because I gotta bounce out in a second. But if I'm looking at Energy Transfer, ET, let me look it up. I remember this stock. I don't know why. I don't know if I owned it at one point or something like that. Here we go. Okay, it looks like it's dipped a little bit. Uh, okay, natural gas pipeline. Yeah, I like Energy Transfer. I do. I do. Um, that's all I'll say. I like it. Also, remember with AI, there's an energy shortage coming. So if you're involved in the energy sector, that looks like a good move or something worth looking at. Our previous Stock Market Tuesday class is available for review. Yes, they are, Leslie. So if you log in at drboystockmarket.com, you will find absolutely more material than you could ever go through in a lifetime. So don't try to go through it all. It'll drive you insane. Just go through what you need. And if you want to, share with your family, do that too. We want you to do that. And there's just so much stuff there. I mean, I've been doing this stuff for years, and I think my weird personality maybe it's a superpower, but I think my wife says I could be on the spectrum for this, is that I've always had the ability to really focus and do one thing for a very long period of time and be single-mindedly focused on achieving one specific goal. I picked that up in my PhD program. My best friend pointed that out. He said, I've never seen a person who could be so single-mindedly focused on getting one thing done for such a long period of time. And he said that when I was 22. He didn't see all the crazy stuff that happened between 22 and 30 where I had to study 8, 9 hours a day, 7 days a week, year round, including Christmas. And so now, same thing happens now when I teach. Everything from 7 years ago is there. So you can go back and look at stuff that I did in 2018. And and I like that because that's how you get good at stuff. Is you repeat yourself. You just take it in. You're constantly consuming it, right? And what's more important, there aren't many things more important than your financial security. So if you're consuming constant economic knowledge to strengthen your financial security, then you're going to be really smart. That's why I confidently say that if you're sitting here and we're talking constantly, you're gonna be the best investor in your family. I guarantee it, including your relatives who have degrees in finance and certifications. That I laugh at stuff like that. I taught people how to get their certifications. So it's a different level in this space. So congratulations to you. I'm happy for you. All right, so Dwayne, thank you for your concern about and great advice. What do you think about AMD Semiconductor? Okay, so hey Dwayne, can we bring stocks up in the next class? And Regina, I see you got a stock as well. We have to actually in class in a minute. But bring it up next time, and I'll promise you, I'll definitely give you my assessment on it. Do you think blockchain ETF would be a good investment? Um, I think blockchain, generally speaking, is important. I think the blockchain technology is just everything going forward. It's right up there, almost as big as or as important as things like AI. Not as important as AI. AI is just ubiquitous, but blockchain is big. Blockchain is good and powerful, and I think we're still in the infancy of extensive use of blockchain. And so you got all these emerging technologies, blockchain, AI, quantum computing, and it's like your head explodes when you imagine what in the hell is the world going to look like in 2040? And and it's not that far. It's not really like this distant future. That's almost like it being 2006 and you asking, what's the world going to be like in 2025? Oh my God, what amazing things are we going to be able to do? So yeah, I think a blockchain ETF I would imagine would be a good move because I think blockchain is going to be the value of blockchain is going to be explored and seen more appropriately going forward. Wyline says, "Hey Doc, I want your thoughts on holding stock long term on the gambling companies like DraftKings." Yeah, okay. So I think the the gambling stocks, it's almost like an ethical discussion at that point. It's almost like talking about tobacco stocks or even private prison companies or things that you might think are connected to, or a lack of ethics, or companies that sell um the oxy drugs and all that, right? If you don't care about all that, if your goal is just to be in a place where you can make money, there's an argument to say that these gambling companies are going to do well because they have an amazing product. It's an addictive product. The best product is where your customers become a bunch of addicts, and that's what they do. They are drug dealers. They're financial drug dealers, and their customers are addicts, and they ain't going away. DraftKings is at the top. What's the other one? Oh gosh, somebody type the names in the chat. I know DraftKings is up there. MGM Bets or MGM something is up there. There's another one that's right. FanDuel. Thank you, Miss P. FanDuel. Yeah. So if you don't care about the ethical issues behind it, then they're in great business models. But the problem is you do have what is called regulatory risk, which is that at some point, I cannot imagine the regulators not realizing that we have just a crisis on our hands and that this is going to be bad and you're going to have backlash. You're going to have class action lawsuits against the companies. You're going to have class action lawsuits against the sports leagues, NBA, NFL. They're going to get hit with this. And eventually the politicians get involved and they start regulating where they can sell their drugs. And so they're not going to go out of business, but their business will be pulled back in. They're going to put it on a leash, and that's going to affect the stock price. So it's for that reason that, and plus the ethical issues that I'm not interested in buying stock in these companies. I don't even want to sit around and make money on DraftKings. I'm like, there's other places I can make money. Let me pick something I feel better about because I'm so angry with what they're doing with sports betting. Gambling addictions are, I feel so sorry for people that have gambling addictions because they just end up in these really dark, horrible places. And it's sad to watch. But with that said, that's my perspective on it, right? The regulatory risk is going to be big, and it's going to become real, and the scandals are only going to grow. There's going to be more and more scandals over time. So so let's assume that if you threw the ethics out, and I didn't care about any of this, that risk right there would be enough to make me say, nah, I don't want to invest in this industry. Now, if I owned a casino or owned, DraftKings and actually got a percentage of their revenue, yeah, I mean, you'd be rich, right? But I think in terms of buying the stock, if you bought it, I would buy it at a time when the stock just crashed. Like wait until the market goes super south. And if you like that company, maybe that's a chance to buy good companies at a good price. Let's see. Last question. I have 300K with an investment company with a 1% fee. I do better with an S&P 500 ETF. This is a retirement account. Yeah, I think a 1% fee is not necessary to pay anybody a 1% fee. Um, I'd be a hypocrite if I said don't do it though, just because I've done this. And I think I did it out of convenience, and it was an account I had with my wife, and my wife felt comfortable with that company, and she didn't really want us moving the money around and stuff. So I paid the 1%. But I'm not a fan of that. I don't think that's necessary. And people like Warren Buffett, and so the question would be like, what else are they doing for you other than managing your money? If all they're doing is managing your money, most people say 1% is too much. Remember, we were talking about the VOO, the S&P 500 index fund, and that fee was like 0.03% per year. So 0.03% is literally 1/33rd of 1%. So, so the question would be, if you got this banker that's charging the 1%, I would just make a list or call them and find out okay, someone told me this fee is kind of big. What are you giving me for my 1%? And what they'll definitely start with is they'll say, we're selecting stocks for you. because they believe that their ability to select stocks is better than other people, which I would probably debate that just because a lot of the research says that that's not um, that stock picking of superior stock picking ability doesn't justify the cost. But the other thing that they can do is they give you diversification. They can make sure you're in different industries and your money's spread out. I think eventually over time you'll learn how to do that on your own. And remember, if you just picked five mutual funds in five different sectors, you'd probably be pretty well diversified with that, right? So maybe they have some other service, like because you've got $300,000 in assets there, maybe that gives you the ability to go in and do banking with them. Maybe you want to start a business and you say, "Hey, I'd like to get a loan from you, and I've got collateral already with your bank." Loan, and that, in fact, that's actually another reason why I paid the 1% was because I was able to do banking with that organization and because my assets were there, I was able to say, "Hey, I got this money over here, and I'm your customer. I need you to loan me some money so I can go and do this business thing that I want to do." And while you can certainly do that with other places, relationships still matter in banking and investing. So if you have a relationship with them and they can document that, then I think that that might open the door for you to make other moves financially, depending on whatever it is you're trying to do. So those are my thoughts. I hope that that helps. All right. All right. So let's get on out of here for today. Don't forget, if you log into drboystockmarket.com, you can find everything that we've done. And I picked some new stocks this week. So check what Dr. Boyce is buying, and there's a list there. And really, you could look at anything that I picked really in the last year or two, and those are still, for the most part, valid in terms of the fact that these investments are assets that I believe are expected to make money if you have a holding period of at least 3 to 5 years. Really, 10 years is preferable, but 3 to 5 years at least. These are all good long-term investments for you. All right. So have a good day, everybody. God bless you. I'll see you next time. Take care. Bye-bye.